Friends, thank you for being here today. The single most dangerous number in the American economy right now is not the inflation rate, though that eats away at our purchasing power daily. It is not the unemployment rate, which remains deceptively low, and it is certainly not the price of Bitcoin or the daily fluctuations of the S&P 500. The number that keeps bank CEOs and Federal Reserve governors awake at night is 929 billion. This figure represents a massive mathematical inevitability. It is the specific amount of commercial real estate debt that is maturing and crashing into a wall of economic reality this year. We are currently witnessing the beginning of the largest asset deflation event in modern world economic history. It is a slow-motion demolition of the office towers, hotels, and shopping malls that have defined our skylines for generations. For the last decade, the commercial real estate market was built on a foundation of cheap money. Developers borrowed billions at near zero interest rates to build glass towers in every major city from New York to San Francisco. They operated under two fatal assumptions: that interest rates would stay low forever, and that occupancy rates would remain at 100%. They were wrong on both counts. Now, the bill is coming due with a vengeance. Unlike the 2008 financial crisis, which exploded overnight with the public and chaotic collapse of Lehman Brothers, this crisis is happening in the shadows. It is hidden behind closed doors, obscured by complex accounting tricks, and buried in the footnotes of regulatory filings. It is a silent crash, quietly rotting the balance sheets of hundreds of regional banks across America. If you believe this does not affect you because you do not own an office building, you must understand the mechanics of the banking system. Your local bank likely owns that building indirectly, using your deposits as the collateral. To understand why this $929 billion wall is so deadly, we must first strip away the jargon and look at the fundamental structure of the loan. Commercial real estate loans are not like the 30-year fixed-rate mortgage you likely have on your home. When you bought your house, you locked in a rate for 3 decades, providing stability regardless of what the Federal Reserve does. Commercial loans are radically different. They are typically 5 or 10-year loans with a massive balloon payment due at the end. During the term of the loan, the developer often pays only the interest, keeping their monthly costs artificially low to maximize cash flow. But at the end of that term, the contract demands they pay back the millions in principal immediately. In a normal, healthy economy, nobody actually pays off this balloon payment with their own cash reserves. The business model relies on liquidity. They simply go to the bank, secure a new loan based on the current value of the property, and use those funds to pay off the old debt. This process is called refinancing, and it is the oxygen that keeps the entire real estate industry alive. But today, the refinancing machine is broken. The gears have ground to an absolute halt. Consider the math. The loans coming due right now were originated in the golden years of 2014 through 2019. Back then, the interest rate on a commercial loan was sitting comfortably at 3% or 4%. Today, if a developer walks into a bank to refinance that same building, the rate is upwards of 8%. This means the interest payment on the debt has effectively doubled overnight. However, the situation is far more dire than just rising interest rates. If it were only a matter of rates, some developers might survive by cutting costs. The true catastrophe lies in the collapse of demand. We are living through a fundamental structural shift in how human beings work, shop, and live. The work-from-home revolution was not merely a temporary trend born of the pandemic, it was a permanent change in corporate culture. Office vacancy rates in major metropolitan hubs like San Francisco, Chicago, and New York are sitting near record highs. In some downtown corridors, 1 out of every 3 office windows you see tonight is dark. I want to pause here and ask you, what does the skyline look like in your city? Are you seeing these empty office parks and dark windows where you live, or are people returning to work in your area? Let me know in the comments below. I want to get a sense of the ground reality across the country. These empty spaces are not just neutral. When a building hits 30% vacancy, it creates a death spiral. It becomes cash flow negative, meaning the rent collected does not cover the mortgage, the property taxes, and the electricity. Commercial buildings are valued based on their net operating income. It is a cold, hard formula. When the income drops due to vacancies and the cost of debt rises due to interest rates, the value of the building plummets mathematically. We are seeing trophy assets in Manhattan selling for 50% less than they were worth in 2019. Imagine if your house lost half of its value overnight, but your mortgage payment doubled simultaneously. That is the exact mathematical reality facing thousands of landlords and pension funds across America today. You might be asking a logical question. If the math is this bad, why haven't we seen a wave of massive bankruptcies on the nightly news? Why aren't banks seizing these towers and putting for sale signs in the lobby? The answer lies in a strategy that Wall Street insiders call extend and pretend. It is a dangerous game of delay designed to mask insolvency. The banks know that if they foreclose on these buildings today, they must record the loss immediately. If a bank takes back a building that has a $50 million loan attached to it, but the market says the building is now only worth $20 million, the bank has to wipe $30 million of equity off their own balance sheet instantly. For many regional banks, taking these losses would wipe out their capital reserves completely. It would make them technically insolvent, forcing regulators to shut them down before the weekend is over. So instead of facing reality, the banks are colluding with borrowers to keep the illusion alive. They are allowing delinquent borrowers to extend the loan for another year, often capitalizing the unpaid interest into the loan balance. They are pretending that the building is still worth the 2019 price to avoid the write-down. They are praying that interest rates will crash back down to zero before the extension expires. But this strategy does not fix the problem. It only metastasizes it. It turns a manageable liquidity crisis into a massive solvency crisis that grows larger every day. The maturity wall of this year was just the first wave. There's another $957 billion maturing next year, waiting right behind it. The vast majority of these toxic loans are not held by the too-big-to-fail giants like JP Morgan Chase or Bank of America. They are held by the banks you use every day. Regional and community banks hold nearly 70% of all commercial real estate debt in America. These are the mid-sized lenders that power small businesses and local economies in your town. They are loaded to the gills with loans on strip malls, medical offices, and suburban business parks. As these loans hit the wall, these banks are forced to enter survival mode. They must hoard their cash tightly to prepare for the inevitable losses. This brings us to the credit crunch that is currently strangling the real economy. Because the banks are terrified of their real estate exposure, they have effectively stopped lending money for anything else. Try getting a loan for a small business expansion, a new equipment purchase, or even a personal line of credit right now. You'll find that the bank officers are polite, but the answer is almost always no, or the terms are so punitive they amount to a refusal. They cannot lend to you because they need every available dollar to cover the coming real estate hole. This sucks the liquidity out of the economy and slows down growth on Main Street. It creates a zombie banking system where banks exist and their doors are open, but they do not actually function as lenders. They are merely warehouses for bad debt, waiting for a government bailout or a total collapse. Have any of you tried to get a loan recently for your business or personal needs? Did you notice a change in the bank's attitude compared to a few years ago? Share your experience in the comments. It helps us build a real picture of the credit market. Regulators in Washington are fully aware of this. The Federal Reserve has been quietly signaling banks to build up their lost reserves for months, but asking a bank to build reserves while their assets are crashing is physically impossible. It is like asking a starving man to save food for next winter when he has nothing to eat today. The danger is not limited to FDIC-insured banks. There is a secondary explosion waiting to happen in the shadow banking sector. Not all commercial real estate debt is held by traditional banks. A massive chunk is held by debt funds, insurance companies, and non-traded REITs. These shadow banks do not have access to the Federal Reserve's emergency lending window. When traditional banks run low on cash, they can borrow from the Fed. When a shadow bank runs out of cash, they face an existential crisis immediately. They have to liquidate assets to pay back investors, selling into a market with absolutely zero buyers. We saw the canary in the coal mine for this trend with Blackstone's Bright Fund. When investors, sensing danger, tried to pull their money out, the fund had to limit withdrawals. They simply could not sell the buildings fast enough to pay back the panicked investors. This gating of funds destroys the illusion of liquidity. It reveals the truth, that real estate is an illiquid asset class masquerading as a liquid savings account. But perhaps the most terrifying part of this story involves commercial mortgage-backed securities, CMBS. These are complex financial instruments that package thousands of individual loans into a single tradable bond. These bonds are then sold to pension funds and retirement accounts marketed as safe, high-yield investments. The loans inside these bonds are starting to rot. The delinquency rate on office CMBS loans has spiked to levels not seen since 2012 and is rising vertically. When a loan in the bundle defaults, the bond stops paying interest. Suddenly, the safe portion of a pension portfolio takes a massive haircut without warning. The rating agencies, the same entities that stamped on toxic subprime mortgage bonds in 2008, are once again asleep at the wheel. They are scrambling to downgrade these bonds, but they are already too late. The damage is done. The equity has evaporated. It is crucial to understand that this rot is not confined to downtown office towers. The contagion is spreading to sectors previously thought to be immune. Consider the medical office sector. For years, investors poured money into medical buildings, operating under the assumption that doctors are safe tenants who always pay their rent. But the operators of these facilities are being squeezed by skyrocketing labor costs and general healthcare inflation. They cannot pay the higher rents required to service the new, higher interest debt. Even multifamily apartments, the darling investment of the last decade, are cracking. In Sunbelt cities like Austin, Phoenix, and Nashville, developers built too many luxury units just as migration patterns began to slow. New supply is flooding the market, crushing rental prices. Meanwhile, the loans on these apartment complexes are often floating rate debt. As the Fed raised rates, the monthly payments on these apartment buildings exploded. This creates negative leverage, where the cost of borrowing is higher than the return on the asset. It burns through equity capital with terrifying speed. Syndicators who raised money from everyday investors, perhaps including some of you, are now sending out grim newsletters. They are making capital calls, asking investors to send more cash just to keep the building out of foreclosure. Most investors are refusing to throw good money after bad, leading to default. Now, you might be thinking, I have my money in treasury bills and I own my home outright. Why should I care if a developer in New York loses their shirt? You must care because real estate is an ecosystem and you live inside it. The collapse of commercial real estate values acts as a massive deflationary drag on the entire economy, and specifically on local municipal budgets. Commercial real estate is a tax cow for cities. In many municipalities, commercial property taxes make up a huge percentage of the total revenue used to fund police, fire departments, schools, and sanitation. When an office building sells for 50% less than its previous assessment, its tax bill eventually drops by a corresponding amount. This leaves a massive hole in the city budget. The city government has two choices: cut services or raise taxes on the remaining base. Since politicians rarely cut spending voluntarily, they will look to the residential homeowner to make up the difference. If you live in a region with high office vacancies, you should expect significantly higher property taxes on your home in the coming years. You will see increases in water fees, trash collection fees, and vehicle registration costs. This is the fiscal drag. It is a wealth transfer from the homeowner to the municipality to fill the void left by the collapse of the commercial sector. This is a critical point. Are you already seeing your local property taxes or utility fees creeping up? I'd be interested to know if the tax burden is shifting in your municipality yet. Drop a comment and let me know. Furthermore, the wealth effect of real estate drives consumer spending. When property values fall, people feel poorer and spend less. When banks stop lending, small businesses contract. This leads to a stagnant, low-growth environment, a zombie economy that shuffles along without creating real prosperity. This is exactly what happened to Japan in the 1990s. After their real estate bubble burst, they suffered a lost decade of stagnation. The United States is currently walking down that exact same path. Beyond the immediate fiscal pain, we must confront an even darker mechanism at play: the urban doom loop. This is a sociological and economic death spiral that ensures values in major cities may never recover to their 2019 peaks. When office workers vanish, the ecosystem of small businesses that serve them, the coffee shops, the dry cleaners, the lunch spots, collapses. These closures lead to empty storefronts, which in turn attract crime, vagrancy, and grime. This deterioration of public safety and cleanliness makes the city hostile to the few workers who are trying to return, pushing them back to the safety of their suburban home offices. It is a self-reinforcing feedback loop. Simultaneously, public transit systems like the MTA in New York or BART in San Francisco face catastrophic budget shortfalls due to the permanent loss of ridership. As they are forced to cut service and raise fares, the utility of the city diminishes further. This doom loop physically degrades the asset class. An office building in a vibrant, safe downtown is a gold mine. That same building in a transit desert surrounded by boarded-up storefronts is a liability, regardless of what interest rates do. We are not just looking at a financial repricing, we are looking at the obsolescence of the 20th century urban model. But there is another hidden layer of exposure that directly targets the retirement portfolios of many people watching this today: the insurance industry. While everyone is watching the banks, very few are watching the life insurance companies. Historically, life insurers have been massive lenders to the commercial real estate sector. They take the premiums you pay for your whole life policies and annuities and invest them in long-term assets like office towers to generate the yield needed to pay you back. If these insurance companies face a wave of defaults in their real estate portfolios, their ability to pay policyholder dividends and maintain attractive annuity rates is directly threatened. We are already seeing major insurers quietly tightening their belts, reducing the cap rates on indexed annuities and raising premiums on new policies. The safety of a guaranteed income stream that many baby boomers rely on is underpinned by the very assets that are currently crashing. This danger is compounded by the rise of private credit. As banks step back from lending, Wall Street has invented a new way to keep the game going: selling these high-risk loans directly to retail investors. You may have seen ads or received calls from financial advisors pitching private credit funds, promising 10% yields in a flat market. Be extremely careful. This is often the dumb money phase of the cycle. Wall Street is effectively taking the toxic loans that banks refuse to hold and packaging them into funds to sell to retirees searching for yield. They are transferring the bag from the institutional balance sheet to your personal retirement account. Do not fall for the yield trap without understanding the liquidity trap beneath it. So, how does this end? What is the ultimate endgame for this $929 billion of maturing debt? The maturity wall creates a binary outcome for the economy. There is no middle ground. In one scenario, the Federal Reserve blinks. Terrified of a banking collapse, they print trillions of dollars to bail out the landlords and the banks. This would essentially be a nationalization of the bad debt. The result would be a resurgence of massive inflation, destroying the purchasing power of the dollar and punishing savers who did the right thing. In the second scenario, the Fed holds the line. They allow the market to crash naturally. This forces asset prices to reset to reality. It causes a painful recession, bank failures, and a credit freeze, but it clears the dead wood from the forest. It deflates asset prices, eventually making housing and business real estate affordable again for the next generation. I am curious to hear your prediction. Which path do you think the Fed will choose when push comes to shove? Massive inflation to save the banks, or a painful deflationary crash to reset the market? Let me know in the comments. Currently, we are in a middle path of slow suffocation, the extend and pretend phase, but time is running out. The debt wall gets higher in 2026 and 2027. The cultural shift away from the 5-day office week is not reversing. We have a massive structural oversupply of office buildings that must be repurposed or demolished. We will see the creative destruction of the American city center. Old towers will be torn down. Land values in these areas will reset to zero or near zero before redevelopment makes financial sense. This is a painful but necessary evolution. Given this crumbling landscape, how do you navigate a financial world where the bedrock of the banking system is shaking? You must take active control of your financial destiny. You cannot rely on the opaque institutions to manage risk for you because their incentives are misaligned with yours. First and foremost, you must stop viewing your bank as a vault. It is a highly leveraged hedge fund that bets on long-term, illiquid loans. Do not keep more than the FDIC insured limit in any single regional bank, no matter how long you have banked there or how nice the branch manager is. Spread your liquidity across multiple systemically important institutions, though too big to fail, banks that the government has implicitly guaranteed. It is unfair that the big banks are safer, but we must deal with the world as it is, not as we wish it to be. Second, if you run a business, secure your credit lines immediately. Do not wait until you have a cash flow crunch to ask for money, because that is when the bank will say no. In a credit crunch, lines of credit are often cut without warning to preserve the bank's capital ratios. Draw down what you need and keep it in a safe, interest-bearing account. Third, remember that cash is king. In a deflationary crash, cash is the ultimate hedge. It gives you options when others have none. Treasury bills are currently paying a healthy yield and are backed by the full faith and credit of the U.S. government. They are liquid and safe. Avoid illiquid investments like non-traded REITs or private syndications that lock up your money for years. Liquidity is the oxygen you need to survive a maturity wall event. Finally, consider the offensive strategy. For those with patience and capital, this crisis will present a once-in-a-lifetime opportunity. Distressed commercial assets will eventually sell for pennies on the dollar. We are not there yet. Do not try to catch a falling knife. Wait for the capitulation phase, when banks are forced to dump assets at any price to clear their books. When the foreclosure auctions begin in earnest, that is the signal to look for generational value. Friends, the silent crash is getting louder every day. It is moving from the back pages of the financial journals to the front pages of our daily lives. The $929 billion figure is not just a statistic. It is a siren screaming that a correction is imminent and unavoidable. We are entering a period of the great unwind. The leverage that built the illusion of wealth over the last decade is being unwound, and it is a painful process. But if you are prepared, if you understand the data and ignore the noise, you can walk away from this crash intact. You must be the risk manager of your own life. Do not rely on the soft landing narrative. Look at the numbers. The vacancy rates, the interest rates, and the maturity schedules do not lie. This is not the end of the real estate market, but it is a massive reboot of the system. In a reboot, the operating system changes, and the winners and losers are reshuffled. Make sure your personal operating system is updated for this new reality of high rates, low liquidity, and structural change. Stay liquid, stay skeptical, and stay alert. Thank you.